Chris Lopez here. Welcome to our webinar on doing 1031 exchanges. I got Sean here from 1031X. We're going to start the presentation about 2 or 3 minutes. And a lot of people are rolling in and getting logged in, so we'll start that. But while we're waiting, can someone out there just give me a shout out that you can hear me? And actually, I would love it if you guys, anyone on here right now, let us know what part of the country you're in. I know we got a lot of Denver, Colorado, but also a lot of national people as well. Let me know where you're from. That way we can help tailor anything to your region or your market. Cool. All right. I'm getting some people here. Colorado, Atlanta, Iowa, Florida. All right. We're getting a stream of people here. Awesome. Texas. No surprise, of course, from Texas. Cool. Awesome. Well, hey, appreciate everyone. So we'll get officially kicked off here in about 1 minute. But you'll hear me say this again. Please ask questions throughout the presentation. Please interact with us. Myself, Sean, we love it. Sean's an amazing job here of putting together a very thorough presentation, encompassing some of the basics and also some of the more current events with marketing additions and upcoming political elections. So as you guys have questions, please ask it. We want it to be engaging and a two-way conversation, not just Sean and myself sitting here and talking to everyone.
Yeah, and to reiterate there, we go through these enough times. It's an old cliche that if somebody asks a question and I answer that, I'm reasonably confident at least one person finds what I'm saying interesting or useful. And I like that feeling. So more questions are better. Don't hesitate to interrupt the flow. And if it's something that we're going to cover later on in this slide deck, depending on the pace, we'll either address it there or I'll just ask you to hold tight for a minute and I'll circle back to you after.
Yeah. And bonus points so everyone can stump Sean. How about that, Sean, right? Put you on the spot.
Say that again for me, Chris.
I said bonus points if someone stumps you with a question.
That's right. If somebody stumps me, you get a sticker. I will mail you a sticker.
Cool. Awesome. Well, we are 2 minutes past, so we're going to officially kick this off. Well, good morning, good afternoon, everyone. Welcome to our webinar on 1031 exchange strategies for 2024 and how you can adapt to this new market we're in of higher expenses, higher prices, higher interest rates. Lots has changed here. So we're very thankful that Sean Ross with 1031X is coming on here to give us a presentation. So a little background here. I've known Sean for quite a few years. I've known 1031X longer as a company. I have used them personally for some exchanges and referred them to clients. But most importantly, Sean and his team are just one of the best resources I've had for myself and many client investor questions over the years. They've always been willing to help out and give advice, their opinion. So they are a wonderful resource. Sean, good morning. Glad to have you on the webinar.
Yeah, good morning, Chris. It's good to be here, and everybody in the chat and who's just watching at home. I appreciate you being here as well. Or if you're watching at work, I hope you're doing so with your boss's permission. As a boss, I can say that. But happy to have you here. Happy to go over the topic. Going to be some mix of some old and some new here.
Great. All right, so 2 little housekeeping topics here. We love questions. If you guys have questions throughout, definitely ask them. If it's a personal private question, reach us offline. We'll share details afterwards. Second, I have to give you the standard disclaimer. We are sharing this information for educational purposes. We're not your lawyer. We're not your financial advisor. We're also not your personal real estate team. So we're sharing this so you can go out there and get education, but always go out there and do your own research, your due diligence, and make sure you connect with your team of professionals. And if you ever want to ask us questions, we're more than willing to, but that is the disclaimer. All right, Sean, let's jump into it. You have the PowerPoint control key, so take it away, sir.
All right. So today we're going to go over what is some standard stuff with 1031 exchanges. You know, what should you know? What's been true for a long time? But I wanted to spice it up a little bit today too with some more relevant topics about the market today and about the political environment today and what it might be tomorrow. So if you have questions on those points too, feel free to ask them. I can't claim to be an expert in all things contemporary politics or in all things with the broader macroeconomic environment, but I will do my best. So we'll start off. I'll introduce myself and the company. 1031X is a 30-year-old shop that's headquartered in Denver. It's been headquartered in Denver for all 3 decades. And it was started by my 2 partners, Steve Hickox and Chris Sayer. Steve's an attorney and investor. Chris Sayer is a broker and investor. And for the first few years, it was mostly a regional Rocky Mountain player, but over time, we really evolved to being more of a national 1031 exchange shop. We do 1031 exchange services in all 50 states, and every once in a while, we'll handle an international exchange too. We have physical offices located in a few major metro areas. We have staff elsewhere throughout the country. A little bit about myself. I'm a Colorado native, born in Denver, went to undergrad at Regis University, where I got my degrees in economics and political economy. And I spent most of my early years in retail banking, financial advising, before I stumbled into copywriting, mostly about macroeconomic issues, distressed assets. We did some bankruptcy work once upon a time. And then I joined the team at 1031X, and ever since have found a great deal of personal psychic benefit from helping people stiff arm Uncle Sam along the way to growing their portfolio and bettering their lives. Our company, I'm proud to say, is pretty routinely recognized as one of the best exchange shops in the country. We can get into some more details about what separates us from other competitors, if that makes sense. But mostly, this isn't a sales pitch. I want to give you guys good information that you can use moving forward. On deck today, I want to talk about why should you know about 1031s? What should you know about 1031s? And if you're considering one, what do you need to know to get started, and how do you navigate it? And maybe most importantly, how do you choose the right partner? And I'm going to settle on that real quick as a quick aside. Those of you who've been in the real estate game for a minute know that there's just a lot that you could or should know, right? You should know or could know about finding the right property, about assessing whether it's a good value, about handling tenants and tenant relationships, local and state and federal laws related to handling your property, how to handle changing market environments, how to handle insurance, if you work with contractors or developers. There's just a ton on your plate. So if you don't have a ton of familiarity with 1031 exchanges, that means you're normal. That means that's a good thing. And feel free to ask any questions here, because this is an old and largely unintuitive part of the tax code. There's going to be a lot of potential tripwires just based on how the code has evolved. The rules around this have evolved over time. So please don't hesitate to speak up if you do have a question. In terms of some contemporary stuff to talk about, we are anticipating an interest rate cut the next time the Federal Reserve meets. How is that going to affect 1031 exchanges potentially? And I also want to talk about politics. The election is coming up. We're not here to take a side on anything. I just want to say that depending on who wins, there could or could not be a potential movement on the 1031 legislative front. So we'll start rolling in about the basics here. If you have never come across 1031, or it's been a long time since you have, the basic is it's an asset swap that goes unrecognized for tax purposes. In English, what that means is if you're selling an appreciated and or depreciated real estate asset, something that normally you would recognize capital gains upon the sale of, a 1031 exchange lets you take the sale proceeds and put them into a new investment, specifically new real estate investment, and not recognize the income from the sale along the way. And by not recognizing the income, you're not paying the taxes. So you can think of it as a way to change the shape or location or type of your investment without paying any IRS-related penalties along the way, penalties in the form of taxation.
And then there's a question here. Is a 1031 only for a property that is sold, or does inherited money qualify as well?
So I see that question here. I might ask for to have the question clarified a little bit, but 1031 exchanges, to be clear, are for properties that are about to be sold, right? If you've already sold a property and have already received the funds from your sale, you're a little bit too late in the game for a 1031 exchange. If you've inherited money, as in just liquid assets that have come into your bank account, 1031 exchanges aren't going to apply to the receipt of that inherited money. If you inherit property and then at some point down the road sell that property, a 1031 exchange could or could not be a good idea for you. But if the viewer that asked the question wants to clarify, maybe give a specific situation that they're dealing with or someone they know is dealing with, I'm happy to follow up on that. We can talk about what qualifies for 1031 exchange treatment here in a little bit, and when you might want to do one. Right now, let's focus on some of the broad overview. If you walk away from this slide deck knowing just a few things, you should know that when you do an exchange, the taxes are only deferred. They're not eliminated entirely. There are some strategies that you can use that can lead to a total elimination of taxes on some of the money that you could have recognized from sale. But by and large, 1031 exchanges defer the taxes into the new investment. And then when you sell that new investment, you can either receive the money and pay the taxes at that time or do another exchange into yet another investment. Not all properties qualify for a 1031 exchange. Only business or investment property qualifies for 1031 exchange. But that definition is fairly nebulous. Most things that you can think of that have some kind of economic use will fall under the 1031 exchangeable asset bucket. There is a specific legal procedure that you need to follow with 1031 exchanges. Most importantly, you'd be hard pressed to do a 1031 on your own. The reason that a company like ours exists is because the IRS says you need to use someone like us when you perform a 1031 exchange. We are a creature of the code. So if you have a property that you're considering selling and you have some capital gains tax that you don't want to recognize right away and you're going to reinvest later, it's a good idea to familiarize yourself with the types of companies that perform these services like ourselves. When you reinvest in a 1031 exchange, you need to reinvest into a new business or investment property. And to make that a little bit more direct, if you're selling, say, a single family rental, you don't want a 1031 exchange into a new vacation home for yourself, at least not right away. I mean, you could do that indirectly, but you really want to go into another property that is held for investment use or for business use. And more specifically, long-term investment or business use. And the distinction between short and long-term there it can be clear and fuzzy at the same time. And we'll talk about that in a minute too. And then finally, there's no limit to how often you can do an exchange. There's no limit to how many times you can exchange in the same chain. You can go from one property to another, to another, to another. And you can do any number of exchanges within a given tax year. That might change based on some proposed legislation that we've seen come down the pike. But for right now, there is no limitation on the number of exchanges you can do in a given year. What are the main benefits for an investor doing a 1031 exchange? Well, the obvious is if you're not paying taxes on the funds from your sale, that gives you more money to put down on a new investment. That's an increase in your available capital. And depending on where you are or how long you've owned the property and your tax bracket, that could be 25 or 40% or even more additional capital that you can put forward. That means you can buy more doors, more valuable doors in a better location, something that fits your lifestyle better. The ability to transfer between properties without paying a tax penalty along the way gives you a great deal of flexibility over how you want to, one, handle your own real estate investment portfolio, but also when you face taxes. It may be true that you're in a higher tax bracket today than you will be in 10 years. It may be true that taxes are going to be higher today than they will be in 5 years, depending on, again, who's running your specific state or the White House. And then there are some estate planning benefits that are tangential to 1031 exchanges that you should be aware of. And this is particularly true if you are trying to build or already have sort of a multi-generational portfolio wealth for your family and for your children or extended family. There are some estate planning elements, 1031 exchanges that you should be aware of. Here I want to pause, and we'll get back to some of the basics about exchanges, but I want to talk about the news coming out of the Federal Reserve. It had been teased as a potential item for, I don't know, let's say 3 or 4 of the last Fed meetings that a rate cut might happen. The next time they meet, it is almost certainly going to happen. You could win money all day long if you could, betting on the fact that rates are going to drop by at least a quarter point. The reasons for this are largely that inflation is slowing down, and if you've seen the economic numbers, the jobs figures have been revised southward fairly dramatically over the last 6 to 12 months. So the economy is a lot cooler, as they say, has cooled down quite a bit. And that means that the IRS, the Federal Reserve might want to step on the gas, so to speak, and make it easier to borrow money and spend that borrowed money in the economy. What does that mean for us? Well, broadly speaking, in the real estate environment, it tends to be true that lower rates mean you're going to be more buyers in the market. Lower rates means more buyers in the market means more valuable. The properties that are on the market might have more demand and increase in value. And an increase in value means you're likely to pay higher capital gains taxes if you sell. So when that happens, 1031 exchanges just become more valuable relative to what they otherwise would have been. It means that obviously financing is cheaper, so that if you are thinking about exchanging into a new property or portfolio of new properties, it's going to be easier for you to afford that. But I want to add this disclaimer that tinkering with interest rates has been a volatile practice over the course of the Federal Reserve's history. And it is not a one-to-one relationship that when interest rates go up or down, that the real estate market heats or cools. Most of the time, when interest rates go down, the real estate market gets a little bit of a bump. But if people have built in from recent experience, especially say 15 years ago, that too hot of a real estate market is actually a bit of a ticking time bomb, well then maybe people sit on the sidelines. Maybe banks actually tighten up a little bit and aren't willing to extend as much as useful credit terms as they otherwise would have. So that's just to say, I wouldn't go out there banking on the idea that an interest rate cut is going to necessarily mean that 1031 exchanges are going to be more attractive, but it's probably true. It is probably true that that's going to happen, which frankly, for everybody who currently owns real estate that they're thinking about selling, that could be very useful for you because it means that more people are going to want what you have and you can sell it for more.
I've got a question on here, Sean. I mean, this is a little bit more just, I always love talking to people like you, where you get to see, you're on a different side of the transaction than I am. But also most important, you just see lots of volume. Lots of transactions go through. Like over the last 2 years, I'm curious, like what trends you've seen either in like transaction volume or just different types of deals as the market has shifted. Do you have any commentary or data points on that?
We do. I'm going to go back a little bit further than 2 years on this one because the tale's interesting and it's different than I would have anticipated going in. So when COVID first hit, early 2020, most of us expected, and it did happen for a short time, most of us expected the market, the economy to really shut down and slow down, and for it to be a hard time for people to, one, borrow money, and then two, find useful assets out there that they might want to buy. The opposite ended up happening by the second half of 2020. It was pretty clear that 1031 exchange volume went through the roof. It was probably a hotter market in terms of both general real estate activity, but also 1031 exchanges than we've seen since before the Great Recession in 2008. And that continued for the most part throughout 2022 into maybe early 2023. And we've seen volume slow down, again, nicely correlated with when interest rates started to rise, back to this relationship. So we've seen that. We've seen that as interest rates climbed and as real estate prices stopped appreciating as much, 1031 exchange activity dropped considerably, maybe 60% the volume that it was at the peak a few years ago. maybe more interestingly, there's been a huge shift in terms of geography and where assets were being sold and where people were trading into. So you always get a lot of exchange activity in the major metro hubs, right? Southern California, the Northeast, and the big cities. The people who are watching from Texas. Texas has always been a hotspot for exchanges. Hawaii has always been a hotspot for exchanges. But and some of this, I think, had to do with the response of some major cities to COVID itself, and how a lot of major cities started dealing with different work situations, maybe crime, maybe homeless problems, maybe inflation caught up with people. You saw a lot of flight, both capital and just people's feet, moving from the West Coast and the Northeast to the Southwest, or the Southeast. So we saw Tennessee, Georgia, Florida, Texas to some extent, the Carolinas got a lot of exchange activity. A lot of people selling in California and going to Nashville, for example. And that trend has been reversing again a little bit here lately from nearest all we can monitor. And we do, a couple thousand exchange transactions in a year. We mark where every sale is and where every purchase is. And a lot of the purchases nowadays are in the Northeast. We're seeing a lot of activity in Massachusetts and in New York and in Pennsylvania and Maryland. So that's unusual. That's the first time that's been true since I've been in the game. So it's a good question. It's an interesting question. Does that necessarily mean those are better markets to invest in? I'm not sure. But if you guys listening are interested in diversifying your portfolio, maybe outside of one geographic area, it might be useful to look up to see where people are moving to and why. It could just be that there are more locations, more jurisdictions that have friendly rules for landlords. It's really hard to be a landlord in Oregon. It's much easier to be a landlord in even Denver, but Denver, Texas is is much simpler and much easier. And as Chris knows, the rules around operating your real estate in Denver have been getting harder for a few years now. So Chris, you can step in with any thoughts you have on that point, but that's what we've noticed.
Yeah, I could speak on that. Just everyone, just make sure you're aware of the legislation that's been passed in Colorado last 2 years. A lot of it's passed with great intent to go out there and help residents. Have the best facilities, but the best houses and the best experiences, but it's also created a lot bigger burden on the landlord. And they no longer distinguish between like the big landlords, and I say us small guys and girls on the call here, where we're, not the institutional, where we own a bunch of doors. So it kind of affects everyone equally. Personally, I think it kind of ends up favoring the bigger landlords because they have the legal counsel and the staff to be able to make all the changes. So if you have a property manager, definitely check with your PM. If you're self-managing and you're not on top of it, just please make sure you're aware of it, because you can get yourself into some trouble and also some pretty big fines as well. So just make sure you don't inadvertently break one of the new rules or laws that have passed. If you guys want any details on there, I've got some really good links and resources to people who are true experts on, the legislative changes around Colorado.
One more point on the legislative front, and that is we've seen rules around the actual execution or prosecution of 1031 exchanges evolve too in certain locations, most notably California. What we tend to see is the California Franchise Tax Board comes up with some idea that makes it harder to do a 1031 exchange, or it makes a 1031 exchange more likely to be subject to scrutiny by local authorities. So you have to mind your P's and Q's, and those ideas tend to metastasize and spread eastward, and you see other state and local governments adopting them too. So if you have real estate assets in, I'm going to call them largely blue cities, although it's not universally true, but largely blue cities or blue states, and if they have a fairly aggressive departments of revenue, then you want to make sure that whoever you're working with on the exchange side is up to date on the changes, so that they're not going to trip over any wires when you do a 1031 exchange, because states like California have been bleeding money for a while. One of the ways to stop bleeding money is by going after people with the money and with real estate assets in particular here, and trying to find ways to disallow their exchange so that you then have to pay California what it considers to be its fair share. So we'll talk some more about legislation actually here in a second, which is the 2024 Democratic Party platform that was released by the DNC maybe a week ago, maybe longer now, did propose several new tax changes. And one of them was the elimination of the 1031 exchange. Full stop. There have been prior attempts by different administrations on different party platforms to limit 1031s, and we'll talk about that in a second. But this one just calls out and says that no other industry has this kind of what they call sweetheart deal. And technically speaking, that's true, that there isn't another group of investors, there's not another asset class out there that has a tax benefit quite like 1031 exchanges for real estate investors. They also proposed eliminating the step up in basis. I don't know, it wasn't very clear if that was for all Americans or just for people past a certain income level. My guess would be that it's for people who are passing on large sums of money to the next generation. But the step up in basis, for those who don't know, if you own depreciated real estate and you pass away and you leave it to your the next generation, the inheritors receive that property with a reset tax basis. That means all of the depreciation and all of the appreciation that had previously been built into the property over the years that you managed it goes away, and they could sell it the next day with no gain. It's a very, very useful tool. So that was a proposed change in the party platform as well. And again, they proposed increasing the capital gains rate. They proposed increasing the corporate tax rate. That won't matter much for our purposes here, but it's the general trend they're aiming for, and more funding for the IRS. On that point, the IRS had received a lot of new funding over the last 4 years. The IRS is very slow at rolling out that new funding, and I think it's still true. They're in a bit of a hiring crunch, and it takes a long time to find, hire, and train IRS agents. So we haven't felt the full impact of the funding they've already received, but this calls for even more additional funding potentially to help speed up that process. And I want to say this: this platform, while on the surface it sounds scary, and it potentially is, we see stuff like this every 4 years, and that's been true for about the last 12 years. Going back, you can find examples of people talking about capping 1031 exchanges prior to 2008, but really starting in the 2012 election cycle and every cycle thereafter, there have been either proposed budgets from an administration or proposed platforms from a national committee that have said 1031 exchanges are either unaffordable because the national debt is out of control, or they're unfair because people that own lots of assets are getting tax breaks that people that don't own lots of assets do. I'm not here to comment on the utility or the morality of any of that. All I'm saying is that we've heard it before, and with one exception, they've all failed. Every attempt like that has mostly been fluff. There's not been real serious effort to put them into effect. And I should say there's two reasons for that. One, there are just bigger priorities out there. And two, there are interest groups, I'll call them, the National Association of Realtors, the Federation of Exchange Accommodators, and other parties that have a very vested interest in keeping 1031 exchanges alive. And I've met with and worked with the lobbyists that go to DC to advocate on behalf of 1031 exchanges. I've attended a couple of virtual fundraisers for representatives on both sides of the aisle to try to advocate for retaining 1031 exchanges. Those tend to be very effective movements, which is good news for all of us here. The one exception, the one time 1031s were hamstrung, was actually the Trump administration in 2017 passed the Tax Cuts and Jobs Act. I might have that detail in the next slide here. Yeah. Which eliminated 1031 exchanges for what's called personal property. That was stuff like art, classic cars, airplanes. You used to be able to exchange lots of assets other than just real estate. All of that went away in after the 2017 Tax Cuts and Jobs Act. And now it's just business and investment real estate that you can perform 1031 exchanges on. Now, the good news there is the enormous majority of people who use 1031 exchanges are doing it for real estate. So this did affect some people, particularly very high net worth individuals who had a lot of wealth built in, sheltered in things like art or classic cars. But so in terms of our own business, we did not see much of a change in terms of deal volume after this took place, because again, the preponderance of exchange activity happens in real estate. And I think Chris just posted, just answered the question there about Colorado legislative changes. And if you wanted to, Chris, in a second, you can talk about that. But say the reality of the national debt and the political environment we're in today is probably such that every 4 years we're going to hear something like this. Maybe every year, depending on the administration, when they issue a proposed budget, you're going to see calls for 1031 exchanges to be reduced or eliminated. And you're probably going to see marketing material from people out there claiming that this means that either 1031s are no longer a good bet, or that you need to do them now, or you have to think about it, go out and buy gold, something along those lines.
That's always the answer, is buy gold.
Buy gold. Hold your horses. If you get a little nervous about something like that, give us a call. You can call the Federation of Exchange Accommodators and talk to somebody who's maybe a little bit more plugged in and can give you some sober analysis on that front. I don't want this to be the bulk of the takeaway from this presentation, but it is something that you should know about, particularly so that you don't get too anxious if it pops up on your social feed sometime. Anyway, Chris, I don't know if you want to talk about what you just posted in the chat.
I won't go into any details. Those are just two podcasts I did with a local nonprofits, a landlord coalition, and the president came on here and talked about the laws. So it's a really good overview. But definitely check with your property manager and go straight to the facts at the Colorado legislature to make sure you have all the correct information. I am not an expert. I am not a lawyer on here. I'm just pointing out, hey, there's some red flags that you need to be aware of, so make sure you are. But I will comment on this. I agree with you, Sean. I mean, I think this is going to be the drums will get beat louder and louder every election cycle. Personally, I am not worried about it. In 2016, when as my first election cycle, I was like full-time investor and very dialed in. I kind of went through my initial, oh my gosh. And as I learned about it, what I've come down to realize from many people who are much more plugged in and do much more donations than I do, they're like, look, there are people on both sides of the party that like real estate. They don't allow real estate. They invest a lot of real estate. I wouldn't lose too much sleep over it right now. And so I'm not personally trying to get ahead of anything in terms of selling any of my properties, nor am I advising any of my clients for it to be a mad scramble to get things in before. But always keep your eyes open on federal legislation and local legislation.
And here, Chris is a very good friend of our company, and we're in communication all the time. And if we hear something from a lobbyist or from an industry organization that causes us concern, we will be sure to tell Chris, and Chris can tell all of you guys.
Yeah.
So you guys will get a notification one way or the other. All right. We carry on here. Okay. So just to reiterate here, if Kamala Harris wins the election and they try to implement parts of the party platform, I just really don't anticipate this to be high on their priority list. There's a lot more to tackle, and there's a lot more to tackle that doesn't have as niche and concentrated a lobbying effort behind it like 1031 exchanges do. Again, I'm happy to say. Okay, so let's go back to the exchanges themselves. When you're selling an investment property, you need to reinvest into what's called a like-kind asset. Now, like-kind is a term that causes a lot of confusion to those who first encounter it. And all like-kind means is another property that you plan on holding for business or investment purposes. And you can see here the IRS defines it. It says properties are like-kind if they're of the same nature or character, even if they differ in grade or quality. Well, here's a list of different types of assets that are all considered like-kind to each other. I won't read all of them here, but this is not an exhaustive list. There are more items that we could have fit on this slide. We didn't because the text was starting to get small. So everything that you read here could be exchanged for everything else that you see on here, as long as you followed the correct procedure and as long as the math worked out. And we'll get into the math in a second. One thing I really want to highlight here is that the TIC property, tenant in common interest, and fractional interests on the right-hand column here, that means that not just does everything on this list qualify for an exchange, but portions of everything on this list qualify for an exchange. If you own half of a duplex, if you own 1/10 of a larger syndicated investment, as long as it's structured appropriately on the ownership side, that could qualify for 1031 exchange. You can exchange out of one of these properties into several others, out of several into one, or out of fractional into fractional, or fractional into whole. There's a ton of flexibility here. So when you see the term like kind exchange, it doesn't mean that if you're selling your single family rental, you then have to go and trade into another single family rental. I like to say you could sell a piece of dirt in Arizona and trade into Yankee Stadium as long as the math worked out. And this and one other concept tend to trip people up and tend to limit the scope of potential reinvestment opportunities for people that are relatively unfamiliar with exchanges. It's a good idea to go into a potential 1031 thinking, boy, there's a lot I could do here. Now it's just narrowing down from the list of lots of good options. You're not being funneled into a short list of potential options. Okay, some other things. Like kind doesn't mean the property has to generate revenue. So if you're selling a cash flowing commercial property right now, you could trade into another asset that could just be raw land that you plan on developing sometime in the future. If you sell something that doesn't generate cash flow now, or you operate a business out of, you could trade into something else that is just earning you rental income later on down the road. And the second point is important because you can buy property with the immediate intent to exchange out of that and into something else. That is, you can exchange into and out of properties without having to hold on to each of them for a long period of time. That often gets confused with a rule that people read about that says that you probably should hold on to a property for at least 24 months before and after the exchange. While that's generally a very good practice, that is not technically required except in a few narrow circumstances. So, for example, my partner, Steve, who one of the original founders of the company, he exchanged out of an office building that our company was, that our headquarters were run out of, and into a new office building, and then exchange out of that one again in less than a year into yet another one, just down the road on Hampton there in Denver. And that was just fine, even though he didn't initially plan on doing that. Someone came to him with an offer saying, "Hey, we like this lot. We want to take it from you. We want to buy it from you." He didn't have to tell the prospective buyer, "Sorry, I did a 1031 exchange into this. Can you come back in a year?" He didn't have to say that. He could accept the deal that was presented to him and simply perform another exchange right out of it. So again, some of the misconceptions you might run into around 1031 exchanges and holding requirement. And as with everything here, this is a very niche part of the code. Don't memorize all the stuff I'm going over here. I want you to get the general sense that things are more nuanced than they might seem at first. And it's a good idea to consult with somebody who lives in this every single day before you perform an exchange.
Let me jump in there and really emphasize this. And I would agree. Yeah, you're right. Don't worry about understanding all the rules. My biggest recommendation is, if any interest in 1031, even before you go list your property, your downleg property that you might be selling, go ahead and go talk to a 1031 QI, because there's so many unique situations, so many considerations, and a lot of deals are have some unique variables in there. So before you even list the property, go talk to Sean and his team, or if you have a 1031 QI, go talk to them. That has saved me, my clients, so many headaches. And I've seen a few horror stories over there where people are like, "Hey, I just closed on a property. I got my check here. Can I do a 1031? Don't. Nope. You can't do that. And you're just going to pay a lot of tax on that money, buddy. So the biggest takeaway is, you want to do a 1031, talk to Sean, his team, or another 1031 QI a few steps ahead before you even ever list your property. This is where prep can potentially save you a ton of money down the road.
I'm going to show this slide and then comment on what Chris just said. So this slide, these are properties that don't qualify for 1031 exchange. And there's a couple I'm going to highlight here, but just to piggyback on what Chris said, if you're thinking about doing a 1031, we prefer, and most QIs prefer, a couple of weeks notice. That way nobody's acting with their hair on fire. And by a couple of weeks notice, I mean a couple of weeks prior to the closing on your sale at least. We have done many, many, many exchanges where you're closing tomorrow or later today. That is possible. But again, it's a little bit better if we can plan and prep and ask proper questions ahead of time. It is too late if you try to attempt an exchange after the sale's taken place, after the deed is transferred, and especially after you've touched the money. Okay, so back to what doesn't qualify for an exchange. Second home and vacation homes kind of exist in a gray area here, and that is to say, you could have a home that you use as a vacation spot. And as long as you're following certain rules around how often it's rented out versus how often you're there, that could qualify. Also, if you're in the practice of buying properties and then turning over your inventory and buying and fixing and flipping, or just flipping consistently, there's a good chance the IRS is going to label you a developer and not an investor. And if you're a developer, then your property doesn't count as capital asset, it counts as inventory. And inventory isn't eligible for capital gains treatment, which means it's not eligible for 1031 exchange. So unfortunately, fix and flips and 1031s don't work together very well. Not a hard and fast rule. Call and talk to somebody beforehand, but that's just something we should point out. And then finally, REITs, real estate investment trusts, because of how the ownership is structured in a REIT, that doesn't qualify for a 1031 exchange. It is possible to exchange into a REIT down the road through an exchange. And if, again, you have questions, you can circle back with me afterward on that. Okay, so I mentioned earlier making the math work. How do you make the math work? Well, in a 1031, if you want to defer all of your taxes, and that's capital gains taxes, that's depreciation recapture taxes, that's net investment income taxes, it's state and local taxes. If you want to defer all of those taxes, then you want to make sure that what you're acquiring on the other end is worth at least as much as what you sold, and that you're moving all of the net proceeds from your sale into the new property or properties. You hit those two requirements, you're going to defer all your taxes, assuming you followed the rest of the procedure correctly. So if you're selling a property, and we'll go through an example here, at $500,000 with a $180,000 mortgage on it, and 320, we're ignoring closing costs to simplify the example here. It's $320,000 in proceeds, and you trade into another property for $500,000, but you only take out an $80,000 mortgage, put down all the money, and then bring in, let's say you're just liquid and you have some extra money you want to put down to lower your loan on the new property. That's totally valid. And this example is drawn up the way it is to get around another misconception, which is that the mortgage, the debt on the new property must be as large as the debt on the old property. While practically that is almost always true, it is technically false. That is, you do not have to do that. You can always supplement with outside cash. What's important here, the sale price, the new property is worth at least as much, and you can see all of the proceeds went into the new property. If neither of those are true, if you don't put all the money down on the new property, or you trade down in value and buy a less expensive property, your 1031 can still work partially. You can still get some tax deferral there, but the difference, the net of what you're falling short on in terms of those two requirements, is going to be subject to taxation and likely subject to the highest possible tax treatment the IRS can apply, which is usually depreciation recapture at 25%.
Hey,
okay.
Sean.
Yeah, go ahead, Chris.
Yeah, I got a question here from a minute ago. Does having your property in a revocable living trust, the property is an LLC held by a trust, does this complicate an exchange or change any of the rules on who or how the title is held? Individual, trust, LLC?
Most of the time, you're good to go here. That is to say, most of the time, if you have a property in a revocable living trust, or in an LLC, or in an LLC that's held by the trust, as long as the chain of ownership results in one tax filing, and then when you're purchasing the new property, whatever name is on title of that property, they're also on the same tax filing. That is to say, it's the same taxpayer, the same income tax return on both sale and purchase, then no, this shouldn't complicate things much. Now, I'm not talking, there might be lender requirements here that make LLCs tricky, but just in terms of the 1031 rules themselves, having property in a trust or an LLC still gives you the flexibility to buy the next property in an individual name, an LLC name, or a trust name, provided that it all comes back to the same tax return. But if it's, say, a multi-member LLC or a trust that for some reason isn't considered a pass-through entity for tax purposes, then you could have some complications depending on how you want to take title to the new property. but most of the time this comes out in the wash and it's not a big deal. It's a good idea to ask before you start and have somebody review it. But Katie, you can let me know if I didn't fully answer your question there. But most of the time, no, it doesn't change many of the rules there.
Great. This might be, if they want to defer this, another question. How does depreciation recapture work with a 1031? And I don't know if you want to punt that or take, because that's a complex one.
I'll give a Cliff Notes version here. So depreciation recapture taxes, and for those who don't know, when you take depreciation on your property every year, when you sell that property, the IRS is going to add up all the depreciation you've taken, and they're going to tax that at 25%. And they're going to say, you have to pay us back that part of the tax benefit that you got over the years of operating the property. If you do a 1031 and you follow the rules I just outlined, buying something that's worth at least as much as what you sold and putting all of the net proceeds into the new property, your depreciation recapture taxes are going to be deferred just like all of your other taxes on the exchange. If you, now this, I'm not going to get into this, the depreciated property being exchanged into a new asset, the tax basis carries over. So you're not starting out with a new basis on the new property, and you can reset your depreciation schedule if you want to on the new property. That's something to work with your accountant on. You can, there are some small details we get into here, but mostly that's outside the scope of what we're talking about. And just say you can still defer all of your recapture taxes with an exchange, just like your long-term capital gains taxes.
Great.
Okay. And Michael, how he thought personal property can't be deferred for depreciation recapture. Personal property, at least as defined by the IRS, and Michael maybe means something different. Personal property is no longer eligible for 1031 at all. And if you mean property that you live in, personal property meaning like your primary residence or a second home, that's not eligible for 1031 exchange anyway. You're probably referring to Section 121 of the tax code. Section 121 talks about an exemption on your capital gains taxes when you sell an appreciated primary residence. And there you're right, your depreciation recapture could factor in there too. But that is a different part of the code. It's separate than 1031 exchanges. Okay. Other important rules, and we'll go through some of these slides quickly here. Very important rule, especially for first-time exchangers. You have to identify what you might want to buy next within 45 days of your sale taking place. You're going to sell a single-family rental. It closes tomorrow. 45 days after tomorrow, 45 days after, calendar days after tomorrow, you have to submit a list to your qualified intermediary that says, here are up to three properties that I'm thinking about buying next. And your exchange can't be considered valid unless you buy something that was listed on your identification list within those 45 days. This is probably the most arduous requirement for first-time investors, exchangers to deal with, because that month and a half goes by very quickly, especially in a rough market. If you're having a hard time finding properties. Now, you can change that list of what you're potentially going to buy next anytime between day 0 and day 45. But on day 46, you're locked into that final list of properties that you're thinking about buying, and you must buy one of those or multiple of those if you want your exchange to be considered valid. The other deadline you have to worry about is the 6-month, 180-day deadline. So 180 days after your sale takes place, you have to complete your exchange by taking title to the new property or properties. That's normally not as big a problem. Most of the time, if you found a property you want to buy within a month and a half, you're not going to need 4.5 months to close. Sometimes it happens, but in our experience, that very, very rarely creates a problem. The bigger issue is the ID list. On the identification list, identifying a property does not mean going under contract or making an offer. It just means writing down an address and sending it to your intermediary saying, I'm thinking about buying this property. I'm happy to answer questions on that front too. There are some other, because we're a little bit short on time here, I'm just going to gloss over a few of these, Chris. If you own real estate in a partnership, that can cause issues on the 1031 exchange front, especially if the partnership doesn't plan on reinvesting as a whole together into the new properties. Partnership divisions before, during, or after an exchange are really, really complicated. It's something you want to plan out well ahead of time. There are some solutions to those. Real quick, if let's say you own a property with somebody else, you've owned it together for 5 years, and then you want to go your separate ways, but one or both of you wants to do a 1031 exchange. Well, you either have to reinvest together into the new properties and then figure out a way to separate, or you can drop out of that partnership prior to your exchange taking place and then do a 1031 exchange with you on title to the portion of the property that you now own as tenants in common with the other investor. And again, I'm happy to get into more details there. Reverse exchanges is a topic that is about as broad as the ocean. Suffice it to say that if you're in a circumstance where either you found a property you want to buy, but your sale hasn't taken place yet, or it's not going to take place until after the purchase closing might happen, you can still do a 1031 exchange, but the mechanics are quite different. Or, and this happens not that infrequently, you are going to sell a property, you go under contract to sell, you know you want to do an exchange, so you go under contract to buy a property quickly, so you don't have to fight the deadline, and then your sale contract falls through, but you still have this purchase looming and you don't want to lose out on that property. It is possible to buy first and sell second in a 1031 exchange, but I'm going to be upfront with everybody here. It's a lot more complicated and typically a lot more expensive to do it that way. So it's something that you want. If we told you before, maybe 2 weeks notice prior to starting your exchange is good. 3 to 4 weeks notice before a reverse exchange, again, is preferred, not required, but preferred, particularly because lenders do not like reverse exchanges by and large. They don't like the idea of how the structure has to be set up to accommodate a reverse exchange, and that makes them itchy. And it's usually our job to talk the lender on the new property off the ledge so that you can still go forward. Okay, same valuation requirements in a reverse exchange. You want to buy something that's worth at least as much what you sold and move all of your net proceeds into that new property. In a nutshell, the way we accommodate reverse exchanges is you say, Sean, I want to buy this property, but I can't sell this one until later. And the IRS has a rule that says you can't own both properties at the same time. So how are you going to purchase your new property first? You don't. You have us substitute in. We create a new holding company, and that holding company buys the property for you and parks it until your sale takes place. And then you can buy the new property from our holding company after your sale takes place. In a nutshell, that's how it works. Okay, and on that, I want to leave some time here for questions. So Mike did have another question there. I see Chris just posted an answer to.
I wasn't sure time to get to. Yeah, Mike asked, I thought personal property cannot be deferred for depreciation recapture, and AKA the 5-year components of depreciation recapture. So what?
Yeah, Mike, I'm not a cost seg expert, so I'm not going to wade into those waters here. I'll have Chris hand out some contact information if you and I want to go down this road a little further. I do know some good cost seg experts. So does Chris. But as far as 1031 exchanges go, and the rules surrounding when you can defer taxes from the sale and appreciated property, depreciation recapture doesn't create a lot of headaches, right? Those taxes are going to be deferred just like your standard long-term capital gains. By following the normal rules of buying at least as much as what you sold and moving all of your proceeds into the new property.
And so I'm just doing a quick screen share because this is a cost seg I did on one of my properties a couple of years ago. And the way they categorize, what I was telling Michael in the private chat, I think it's just the same phrase being used differently by two different aspects of businesses. So when I've done cost segs, my CPA has told me, hey, I get to depreciate it today. And when I sell the property, we'll have depreciation recapture. And you can see here, I think the way they classify in cost seg studies is like they call it personal property, which is like the rugs and cabinets and paint. So it's like, doesn't mean your personal property. It just means personal property on the building, which still counts for depreciation and also depreciation recapture. Again, go talk to your CPA, but I just wanted to kind of share what I've experienced and just a real life report as well.
Mm-hmm. Mm-hmm. Thanks for that, Chris. Okay, we got a few minutes left here. I'm happy to answer any other questions, Chris, that you have or that the folks in chat have.
Yes. So a couple questions I've got here from people that could not make the call. One person, they own a rental portfolio. They are new, or they are thinking about doing some trade ups. And they have a lot of questions around trust and due diligence for 1031 QIs.
Mm-hmm.
So, hey, there's a lot of companies out there like 1031X, and you guys are going to hold a lot of money,
Mm-hmm.
for me or for a client, $500,000. How can I make sure that you're a trusted company, or a QI is a trusted company, I should say?
Yeah, there's one of the double-edged swords in this industry is that there's not a ton of oversight. We're fairly lightly regulated, especially compared to most other financial intermediaries. Most of the time we love that, but it does create scenarios where it's just kind of hard to know what rules a 1031 company has to follow and if they're following them, and just what are good business practices. You want to work with somebody established, and you want to have good recommendations, ideally from somebody. Most 1031 companies who are well established and know how to follow protocols, one, have a track record, and two, they make sure to hold your funds in what are called qualified escrow or qualified trust accounts. That is an account where your money is coming from the sale, and those funds can't move unless you give your written and verbal authorization to do so. And the funds aren't commingled with anybody else's money, so that way they're not putting it into a giant pool and investing it on the side and trying to skim off the top there. You want to make sure that they have it's not necessary, but ideally you want somebody that's a part of the industry, right? So they're up to date on best practices, member of the Federation of Exchange Accommodators, maybe they have certified exchange specialists on staff. There are two big issues here. One, 1031 companies in the past, and even in Colorado in the past, have absconded with lots and lots and lots of money that their clients entrusted with them through the course of doing 1031 exchanges. And fortunately, those people have gone to prison for a long time, and we don't like wearing orange. But the other is wire fraud is a very big issue in real estate. So even if you can trust the company and the people that inhabit the company, you want to make sure that their procedures are such that a nefarious third party can't jump in and steal the funds as they're being transferred, or have them erroneously sent to the wrong account. Long story short, you should have a conversation with your intermediary about how they're safeguarding your money, and what their experience is in terms of handling the protocols surrounding 1031s, because of course you don't want them to make a paperwork mistake. You don't want them to make a procedural mistake where the IRS later on is going to throw a red flag and say, sorry, your exchange has been disqualified because your accommodator didn't follow the rules.
And I shared some comments in there from Matt. He's a local investor I know, and he's been an investor, I think, for pushing 15 or 20 years. And he says he's done over $1 million with 1031X without a problem. Lots of investors have used 1031X. So in addition to like talking to the qualified intermediary company, also just check the track record, all on reviews. Hey, is this their first transaction or like 1,000th or 10,000th transaction?
Mm-hmm.
If they've got a few hundred or a few thousand transactions, that's generally a very good sign as well.
Mm-hmm. Yeah.
But
we've done tens of thousands of transactions, billions of dollars of money have changed hands. It never had an issue there, knock on wood. And as Matt here mentioned, we do hold a lot of our funds at the Bank of Colorado. If you're outside of Colorado, they're part of Pinnacle Bancorp. So they're got a small community bank feel, but they're really a large player with a lot of backing. They're a great institution. We really enjoy working with them. We also hold some money at Capital One Bank and a few other, but we work very closely with our deposit institutions to make sure that things are held securely and handled appropriately.
Cool. Question here from Jen, and then we got like 2 minutes left. I want to sell my condo in San Francisco and buy a multifamily in Brooklyn. We will use one unit, as a primary and a second unit as a rental. Is this qualify for 1031s?
Jim, the answer is probably yes. So You can trade out of a property that is just held for business or investment and into a mixed use asset, something that's held for personal and investment use. So if it's a multifamily where one unit you're living in, you just need to know that the value apportioned to the unit you're living in isn't going to qualify in terms of meeting your 1031 requirements. So to make a simplified example, if you're trading into a duplex and you're living in one half of the duplex, then you need to make sure that the half that you're going to be renting out is worth at least as much as what you sold in San Francisco. If you sell in San Francisco for $1 million and then buy a duplex that itself is worth $1 million, but you're living in half of it, well, the IRS is going to look at that and say your replacement property for purposes of the exchange is only $500,000. So you're not meeting the requirement of buying something that's at least as valuable as what you sold. So you can do that. You can combine the use of a property, either trading out of or into as part of an exchange, but work with somebody to make sure the math lines up.
And one thing I want to make sure, because I know we got lots again, this is the great types of questions that, hey, for your specific scenario, make sure you talk to 1031X or another, your qualified intermediary company. I'm going to share 1031X's contact details. www.1031x.com is where I always go to. It's just kind of burned in my memory. Great domain. But there's your email. There's a phone number as well. Exchange at 1031X will be the best way to get a hold of it. And they'll get you in touch with like the best QI, a lot of times based on state. I've done a lot now with Scott, who's their Denver. I don't know what his title is, but I work with him all the time in Denver here. So if you have any specific questions or scenarios, like we're getting some here, please reach out to Sean and his team. Might be Scott if you're here in Denver. If you reach out, they'll get you connected with the right person. But we'll start wrapping up here. I appreciate everyone coming out. Again, go through here, learn the highlights from this webinar, from Google, from forums out there. But always go out there and make sure you talk with a specialist, whether it's a QI specialist, your CPA as well. Talk with the team that knows taxes. And please do it as many steps ahead as before you even list the property, because it starts getting very complicated when you start talking taxes, and time and prep is your friend. But Sean, thank you so much. I know you've had a very busy schedule. He and his wife just welcomed their second child here recently. So appreciate Sean making time and probably drinking a couple extra cups of coffee here with us to join us for the webinar today. So Sean, thank you. It's always a pleasure talking with you. And again, if you guys have any questions on 1031X or 1031s in general, please reach out to Sean and his team. And I see a lot of congrats to you, Sean. So congrats seeing your family.
I appreciate that, everybody. That's right.
All right.
Thanks, Chris. Thanks, everybody else.
Thanks, everyone. We'll see you soon. Bye-bye.